I'm with the Life and Annuity Marketing Department here at Western Marketing. Today we'll be going over Annuities 101 and some of the basics and different types of annuities. Today we're going to cover what an annuity is, the different types of annuities, the characteristics of annuities. We'll talk about interest rates as well as ways that interests are credited to an annuity. So an annuity, by definition, is a fixed sum of money paid to someone each year, typically for the rest of their life. It's a form of insurance or investment entitling an investor to a series of annual sums. Now, there are many different uses, and they are quite wide based on annuities. The basic common elements of annuities are these four main categories. There is a free look period. Talk about that here in just a minute in more detail, as well as a death benefit. There are guarantees. There are annuitization options. And the fifth is a surrender period, which we'll also talk about as well, which are very different based on the type of annuity. A free look period is basically a time in which an annuitant or owner of an annuity can receive that annuity and decide they don't want to purchase it. They don't want to keep it. It allows them to receive it, view over it, and if something doesn't seem quite right to them, they can surrender it, and that is what is called a free look period. That is typically 30 days, but can and will vary by state. Now, during this contract period, like I said, you can get a refund of the premiums paid in. Now, a death benefit on an annuity is typically the value of the current investment or accumulation value at the time of death of the owner, or it can be the original amount of the investment. Annuities will differ. That is where this is where a specific type of annuity will differ in some ways. Guarantees. Guarantees are the minimum interest rate an annuity will credit or will provide. Most annuities offer a guaranteed rate, or an index annuity will also have what's called a separate bucket. And when we're talking about crediting on an index annuity, that's based on a fixed rate of return. Now, annuitization, not so typical anymore, but annuitization is the process of converting an annuity or investment into a series of periodic income payments. Annuities can be annuitized for a specified period of time or for the life of the annuitant. Annuitants can arrange for beneficiaries to receive a portion of the annuity balance on their death as well. Surrender charges and liquidity. So a type of sales charge that you must pay if you sell or withdraw money from an annuity during the surrender period. Annuities lasting typically from 1 to 15 years in length, and surrender charges typically will reduce the value and the return of your investment, not typically, but they will. And most annuities do offer what's called a penalty-free withdrawal. So this is a liquidity provision with inside an annuity. Typically, that is going to be 5 to 10%. Now, the different types of annuities, the four main categories, are multi-year guarantee annuities. These offer a predetermined and contractually guaranteed interest rate of return for a fixed period of time. Think of it as a CD. A CD pays an interest rate for a fixed period of time. A multi-year guarantee annuity pays a fixed rate for a defined period of time. Now, fixed index annuities are a little different. They may have a fixed bucket option, but they also have crediting based on an underlying index. The most common is the S&P 500. That is the largest index of 500 large companies in the United States. And they will look at that based on how the S&P has performed. We'll talk a little bit more about that in detail in the next couple slides. There also is a single premium immediate annuity. This is in which you pay a sum of money, and this begins a period of payments. Those payments can be for a lifetime or for a defined period of time, or both. Variable annuities, these are They are based on the performance of what's called a sub-account. A sub-account is usually held within mutual funds or exchange-traded funds, and they're typically can vary based on what the market is doing. So they have upsides and downsides, whereas the cousin of them, the fixed index annuity, usually has a floor or a basis in which you cannot go below. Here's a little bit more on fixed index annuities. As said before, they do have a fixed rate option typically. These are the different buckets of money that you can put your money into a fixed index annuity. One of the most common options is an annual point-to-point with a cap. Let's just say we're tracking the S&P 500 on an annual point-to-point cap, and let's say that cap is 5%. If the S&P 500 from January 1st of this year to January 1st of next year returned, for simple numbers, 10%, and I have a 5% cap, I have 5% credited to my account. There is a monthly cap, which is similar to a point-to-point cap, but this is just on a monthly basis. So we're going January 1st to January 31st, February 1st to February 28th, so on and so forth. And that will give credits based on a cap on that percentage, or I'm sorry, that gain in the index during that time period. Participation rates are another way to credit index annuities. In essence, a participation rate gives you a percentage of what the index returns. Let's say, for example, we are tracking the S&P 500 still, and we have a 10% gain from January 1st to January 1st of next year. And we have, let's just say, a 60% participation rate. The index returns 10, 60% is the credit of that amount of the percentage of 10. So it's obviously 6% is credited to the account. There is a spread option, which is coming a little bit more back in fashion. A spread option is basically a reduction in what the interest credited to the account on a index would be. As an example, let's just say the spread was 4%. The S&P 500 on an annual point-to-point did 10. The spread is 4. You get 10 minus 4, which would obviously equal a 6% credit to the account. Earlier, we talked about annuitization, not so popular anymore. Income riders tend to be a little bit more popular. So the basic way to think of an income rider is almost like a kitchen faucet. You can turn the money on and off as you choose. Why would somebody do this? Things can change. Money can change. Their financial needs may change. They can decide to take an income stream that will pay out for their life. So I have an index annuity with an income rider. That income payment will last as long as I am alive as the owner of the annuity. Second thing is that it will keep on paying, and ultimately, if my bucket of money or my accumulation value in the annuity went to zero, it would still keep on paying because of the guarantees in an income rider. That is the essence of annuities, Annuities 101. I want to thank everybody for taking time out of their schedule to view this video. As you can see, here is my information on the screen. Again, Nick Randall. You can email me, and then our phone number here at Western Marketing is 800-852-7152. Thanks so much for watching Annuities 101.